Welcome to the Rimon Law Podcast. I am Brent Nelson, and per usual, I am joined by Rachel Sass. Rachel, how are you?
I'm good. How are you doing?
I'm doing well. I feel like I have to say the one and only Rachel Sass.
The one and only.
Yeah, like people will be confused. There could be another Rachel Sass, but I'm not talking to that one.
There was a Rachel Dykman, my maiden name, but I have not discovered another Rachel Sass. Actually,
Well,
my cousin married a Rachel, so there is a Rachel Dykman definitely out there.
okay.
But
Okay.
yeah, no Rachel Sass is out there. The one and only.
The one and only. The one and only that you're aware of, or that I'm aware of, I should say.
Yeah. Maybe I need to do some Googling. We'll see.
Well, we are lucky that we are joined again by our friend Shiraz Ahmed. Shiraz is coming to us from the beautiful city of Toronto, Ontario, Canada. Although we just learned it is the most locked down city in the world. So, we're sorry to hear that, but we're also glad to hear that you're still able to project from your basement. Shiraz, Shiraz is a financial advisor and portfolio manager with Sartorial Wealth of Raymond James Limited. Shiraz has a cross-border financial planning practice, somebody that we really like and enjoy, and a friend of ours. So Shiraz, thanks so much for joining us again.
My pleasure to both you, Brent and Rachel. Thanks for having me. It's unfortunately, it's still doing this from my basement. Hopefully, there is light at the end of the tunnel. That as the vaccination rates start to pick up, that hopefully I can get out of my basement and actually go back to my actual office, which would be awesome. So, but yeah, no, thank you so much for having me.
Yeah, our pleasure. We hope very much that you'll be able to get out of your basement sometime soon. So, for what it's worth. I thought for the good of the order here that we could talk about a couple of things because it's actually we're recording this on May 17th. That's actually the tax filing deadline in the United States, and it happens to be the contribution deadline for IRAs in the U.S. Those also important retirement accounts. But I thought maybe we could look at things from the Canadian viewpoint, from the American viewpoint, talk about the contributions, the deadlines, the limits for RRSPs, or registered retirement savings plans in Canada, and IRAs in the US. Talk about things like backdoor Roths or Roth accounts in the US and whether or not that is a good or bad thing in Canada from your perspective. And then we can talk a little bit about just catching up on the year. This has been a very strange year, probably a very strange year and a half. And I think there's been a bit of a digitization of self-help in financial advisory, somewhat poignantly emphasized through the whole Robinhood experience. And maybe from that, it will lead to a conclusion that people really need, rather than winging it and doing everything piecemeal, really do need to put together a comprehensive, logical plan for investing, which could be much better for them. So I thought we could talk about those things. And of course, if the two of you have other things you want to talk about, we can talk about those too.
Absolutely. So if you want to kick it off, Rachel, perhaps, then I'm happy to jump in.
Yeah, that sounds like a plan to me. Yeah. So like Brent mentioned, so we are on tax deadline day. I know a lot of accountants who have already taken off on their vacations for after dealing with another long tax year. But like Brent said, it's also the deadline to make IRA contributions. And that's for the last previous year. You can make it all the way up until the tax deadline. Same thing goes for, every continuous year. Now, I think we need to take it back first just a bit and looking at retirement accounts, IRA versus 401k. 401k plans, people know it's typically with your employers. And so, you will put in so much of your paycheck each week or each 2 weeks, whatever it may be. And then your employer typically has a little bit that they'll put in as well, maybe a matching portion. And that grows, and there you go for retirement. IRA is a little bit different. IRA is an individual retirement account, so you're putting the money in yourself. There's a lot of rules with IRAs in terms of contribution limits and in terms of your what your gross income can be each year. And so that's how we'll get into the backdoor Roth IRAs in a bit. But yeah, so that's just kind of a little bit of the basics, and so we can kind of just go from there.
Absolutely. I can fill in a little bit on, at least on the Canadian side from an RSP standpoint. So RSP is considered the vernacular is Registered Retirement Savings Plan, very similar in nature to an IRA in that it's an individual contributed plan. So you actually put money in yourself and you receive a tax incentive by the government for contributing to your retirement in that they lower your taxable income by the amount that you do. There is a limit every single year. For Canadians, it's actually significantly higher than Americans. This year, I believe, is $27,830 you can put in into your RRSP this year. That's the maximum. Again, depending on your income levels, you can also max out to 18% of your income, whichever is lower. That's actually what you have to be able to do. So if you don't make necessarily $200,000+ a year, you may be not reaching the maximum limit. However, at minimum, you should be able to put 18% of your income away, and it is typically encouraged. Now, if you are one of the rare few left people who are contributing to a defined benefit or defined contribution pension plan, there is a pension adjustment that does happen on your taxes every year. So the amount that you're able to contribute to an RSP typically gets reduced. And if you're ever questioning how much can I put away, this is why it's a good idea to sign up for your MyCRA portal, so you can actually go in and actually get right from the government, right from the horse's mouth, how much can you contribute this year. And the deadline is actually March the 1st of every single year of the following year. So this past March 1st, you could contribute the maximum amount or whatever your maximum amount was for the 2020 tax year.
Lucky for us, our maximum amount of contribution is a grand total of $6,000.
I mean, if you're over 50, you could put 7,000.
You could, yeah, that's true. That's true. You get your makeup contributions if you're old enough. We have limitations on making contributions to IRAs. Well, really, these are limitations that apply to taking a deduction. And sort of said another way, having the government subsidize what that $6,000 that's going into your IRA. So in 2020, the phase out started at 196. I got that in reverse. $196,000 of adjusted gross income, and then it phased out just north of $200,000 of adjusted gross income. So if you were a doctor earning more than roughly $200,000, and you're married and you're filing jointly in the United States in 2020, then you would have been phased out and you wouldn't have been able to make a deductible contribution to an IRA. But you can always make a non-deductible contribution to an IRA, and that would be one that you put after-tax money into the account. So you're going to have to pay tax on that money. You don't get to take a deduction, therefore it doesn't reduce your taxes by making the contribution. And the way that usually dovetails with these 401k plans that Rachel is mentioning is that, first of all, a lot of high income earners are working for an employer of some variety, and the employer then has a 401k plan that has the ability to do what are called elective deferrals. Elective deferrals being you put the money in, you direct the money to go into the 401k plan. It gets taken off the top pre-tax from your wages, so that in effect, the money that goes into the 401k is like deductible money because you're not paying tax on it. And those contribution limits are higher. I think this year was 19,500 or somewhere around 19,000. I probably should look that up for purposes of giving all the listeners accurate information, but just know it's somewhere in that range. And Google will tell you what the exact number was. But the more substantive point is it's the contribution of pre-tax money, where it operates a lot like a deductible IRA contribution, because the money goes in before it's taxed, meaning before taxes are withheld from those wages, they're contributing into the 401k. It doesn't even show up on the employee's W-2, for example, as taxable income. So those 401k plans could be quite handy, but if you have a high earner, they could be contributing to the 401k plan, but be maxed out where they could not make an additional deductible IRA contribution, but they could make a non-deductible IRA contribution outside of the 401k plan. So you can get your, say, $19,000 in through the employer plan, plus the employer matching, plus the $6,000 your makeup contributions into a non-deductible IRA, if somebody was inclined to do that. Which I think ultimately then makes the numbers, the contribution numbers as between the RSP and the IRA, when it's dovetailed with the 401k, somewhat similar, even though the IRA number is a lot lower. Yeah, the numbers wise.
They're close. Numbers wise, they're closer. I think the major advantage I'd say that Americans do have is, especially if you're in a 401k and it's an employer sponsored plan. So you do have that matching amount in a lot of cases. It's not always there, but in a lot of cases you do have that matching amount. And that is where effectively for your average employee, that's free money, right? So that's always great. On the Canadian side, you do have what we refer to as a group RSP plan, which is probably the closest comparison to a 401k plan, where it's an employer sponsored plan. We may or may not allow you to match. So they may or may not throw in money with you. And it's usually based out as a percentage of your income, subject to similar limitations and whatnot as well. So it's I think they're both really great, but they're very different systems that we have, and they don't always kind of one for one match up. Like you guys have the Roth in the US, we have a tax-free savings account in Canada. I still will say to this day that I think it's an improperly named account. It should be tax-free investment account because it's not a bank account, and people commonly misunderstand that as a bank account, and it's actually not. It's an investment account. So, but nonetheless, tax-free savings account, very similar in nature. Limits are about $5,500, similar to a Roth.
Yes, unless anybody be confused, we're not saying that these two systems are equivalents of one another. They're not at all, and they don't operate identically, and both countries don't treat them identically. So, all right. So one other, you kind of teed this up, Shiraz. One other possibility in the U.S. then is the Roth IRA. Similar contribution limits to Roths in the US, similar limitations on making Roth contributions that relate to income, like the ones that I was citing for married filing jointly taxpayers in the US. There is a way to make contributions to a Roth even though someone is above the adjusted gross income limits. And it's what's referred to in the industry as a backdoor Roth. And it basically works something like this. And I should say this is sort of it's a relatively technical little transaction, so nobody would want to do this without getting good advice. Okay, so this is just a general explanation of the way it works so people can conceptualize it. So number one, let's say that you're an employer and an employee, and you have a 401k plan and you have maxed out your contributions, these elective deferral contributions to your plan, and your employer has maxed out their contributions into your plan for this employer matching. Okay, so now there's no more money that's going to go into the plan, but the plan says if you want, you can make additional after-tax contributions into the plan. Usually those after-tax contributions are capped so that the total contributions can't exceed a certain limit during the year. So we'll say it's $35,000. It's somewhere around there, but it's adjusted for inflation, so the number changes every year. But let's say that person decides, I want to actually make more contributions than what I've already made. And the plan says, if you, the employee, want, you can treat after-tax contributions as Roth contributions. You just make an election, they'll be treated as Roth contributions. Well, that employee could then direct their additional contributions, their after-tax contributions into the 401k to be treated as Roth contributions. So now their 401k is split into two pieces. One is a traditional 401k and the other is a Roth 401k. The difference being when the money comes out of the Roth 401k, it's income tax free. But you have to put in after-tax money. So you're going to pay tax. This can be as like withholding tax on those wages. You're putting in after-tax money on the front end. Okay, that's one scenario. Another scenario is, let's say somebody doesn't have that, or their 401k doesn't provide for a Roth component, but they still want to make a Roth contribution and they're above these income limits. Then what they could do is make a non-deductible IRA contribution. And so that's after-tax money that goes into the IRA. And then after they've made that contribution, probably not on the exact same day, they decide to convert their traditional IRA that's now holding this after-tax money into a Roth IRA. So they can convert it into a Roth IRA. There's no penalty for doing that other than you're required to recognize any of the growth that was in that account, okay, which presumably there would be almost none because it's happening within a relatively short amount of time. And there are no income limitations on conversions into a Roth account. And so you can, even though you were restricted from making a direct contribution to the Roth IRA, you can make this after-tax contribution, non-deductible contribution to a traditional IRA, then you convert it to a Roth. And so now you have a Roth account, the so-called backdoor Roth contribution. So all of this is to set up that Roth IRAs are very, very popular in the US, very popular with financial advisors as well. I'm very curious about whether they work for Canadians or they're more trouble than they're worth.
So that's a loaded question. And so my best way to explain it, so first off, I just want to correct one thing. The 2021 contribution limit for FSA is actually $6,000, not $5,500. They just keep changing that number every year. So depending on they love changing these numbers around, which make it, that's thankful for all of us for Google. But to be perfectly frank, so in my practice, because of the fact that I'm a cross-border advisor, we don't do as many Roths. Predominantly, we do a lot of 401k rollovers and IRAs. That seems to be probably the most common transaction that we end up doing. But that being said, the Backdoor Roth is an absolutely viable tax-based strategy for American residents. It is not so great for a Canadian resident. And the only reason why I will say this is I don't profess to be a tax expert, but there is an extra layer of complication for a Canadian resident having a Roth IRA. In that there's a special election that needs to be done, what's a one-time election that needs to be done with CRA in order to not have the Roth be subject to withholding taxes in Canada, that all FIs are required to levy like immediately. And it's not our choice. This is what gets imposed on us. So unless you file that election, you can basically get the taxes back on it. But it's not the most commonly used tool for cross-border purposes, and simply because in Canada we have our Canadian equivalent, which is the tax-free savings account, but that's a 3520 issue for an American, so that's another separate can of worms as well. Although I've been hearing, and perhaps you guys can comment on it, that the IRS is lightening up their stance on the tax-free savings account, in addition to the RESP as well, the Education Savings Plan. But I haven't heard anything official from anybody yet, so the general advice is still avoid if you're a U.S. tax filer.
Yeah, unfortunately, I have not seen anything official from the IRS saying that they're going to touch those things with a light touch. And the issue that Shiraz is pointing out is just that for an American resident to own certain types of foreign retirement accounts or foreign pension accounts, some of them are kind of blessed by the IRS in a sense, although it's all very, very complex, and I don't mean to paint with too broad a brush, but for better or worse, the RRSP is in the blessed category in certain instances, but that's not the only kind of retirement account you can have in Canada, like we're talking about. And so you could have a different kind of account that's not one of the blessed ones that then has a very high tax and compliance burden in the United States. So it sounds like it's actually kind of similar in that, from a U.S. perspective, for somebody to have a non-RRSP account in Canada could actually be problematic for them because they may not get the kind of tax savings that they were hoping for. And then the reverse could be true. A Canadian resident holding a Roth account that doesn't make the right or timely election could have Canadian tax issues that relate to that Roth account that really aren't going to serve them very well.
Right. I mean, what I always tell everybody is if you already have one, it's not the end of the world. So it's fine. I wouldn't want anybody to trigger a lot of stuff by selling and getting out of it. Like if you have it, it's hard to get it back again. And let's say, for example, that you moved. You just need to make sure that you do speak with a qualified cross-border CPA, get your elections done, and then that way you can keep it going, especially if you have sizable amounts of money in your Roth. And again, if you're a U.S. person living in Canada, and you do, let's say, decide to dissolve your Roth, you have limited options in what you can do elsewhere to be able to shield yourself, at least from a either exemption on taxes or deferred tax situation, because there are limitations. And, an RSP only has 27,000 that you can really put away. So, if you're hitting the higher income levels, you want to have other kind of spillover methods to be able to continue to shield some money. And if you haven't been in Canada long enough, then that's also another problem. You have to be here at least a tax year before you can start contributing to a lot of these vehicles. That's a big mistake people make, is they come here and they immediately, other than pensions, which is a kind of a caveat, and I won't talk too much into that one, but typically you need to wait a full tax year before you can then start contributing to any of the retirement accounts in Canada. So you've earned your contribution room effectively.
Yeah, all to the point of all of these things are very complex. And so when people are ready to make contributions, especially if you have a cross-border scenario, like you really need to talk to somebody before you do it. Like it's a thicket, and there's so many landmines and traps for the unwary that you would easily make a mistake if you weren't well advised before you went off and did the thing. So hopefully people will take that to heart. Yeah,
it's a big one. So, and I think part of it is I think, kind of segueing to one of the other topics is, the whole idea of the do-it-yourself investor has really taken off in recent years, right? And we're seeing that with this whole Robinhood, that whole wave of sort of self-directed investing to make it really easy for the individual investor to do it. And I think it's great. I think there's nothing wrong with it. Every type of investing paradigm has a fit for the right type of clientele. So not everyone needs full service, not everyone needs a robo, not everyone needs a do-it-yourself. And I think there's a place for them all. But one of the things that specifically in cross-border is because of the dual nature and licensing requirements, whether it be for taxation purposes or for advice purposes, it's just inherently complicated. And because of the fact you're dealing with two separate countries, I always say that cross-border is basically the intersection of three sets of laws in two different countries. It's immigration law, tax law, and securities law. And they don't always perfectly match up, right? So you need to really be aware of all the different variables. And unfortunately, people go on forums and all these other things where you may not necessarily have professionals giving you guidance or advice. And then they may turn to their own domestic financial institution for guidance, who can probably give you great guidance for your domestic circumstance, but perhaps they don't know as well the contra country. So like an American institution might not know the Canadian rules and vice versa. So it's always really, it's advised to seek out appropriate counsel, whether it be from an attorney, whether it be from a CPA or a financial professional, somebody who can really, or a series of people who can help you guide through this kind of complicated web of rules that we all need to kind of go down. But I think it's something that people do a lot, and I think it's great that you should do it and do your own homework, do your own research, but just be wary of a lot of misinformation, because there is unfortunately tons of it.
Absolutely. I can't agree more. I think in this day and age, we've got so many like retail investors who, on Reddit and learning how to do it themselves. I think it's very much like you said, it all depends on your circumstances, right? For the very, I would say basic, if that's, I could probably use a better term, but for the basic investor who's just trying to get into it, right? Let's just say someone who's fresh out of school, they've got an extra $5,000, $10,000. How am I going to invest it? Okay, do your research, right? You can be on these forums, you could start doing it. But when you start adding in multiple layers of complexity, that's when you really need to start getting professional advice. If you are looking into more foreign investments, you've got the cross-border aspect, your net worth increases, right? We see this all the time in the estate planning context, where we get questions all the time. Well, why can't I use, LegalZoom or Rocket Lawyer? Why can't I do my estate plan online? And that's a whole nother conversation on its own. But it really starts off with, you need someone who knows your particular set of circumstances and what those implications are going to be for you, right? Again, if it's a very simple client, maybe they could figure it on their own. Again, I would probably still not recommend it. But when you start adding a net worth where now you've got a potentially taxable estate, no, those aren't going to be the right vehicles for you. You really do need to sit down with a professional advisor who could really tailor everything directly to you. And I think that's exactly how it is on the investment side.
Well, and to kind of dovetail on that, I think there is a component of access that is a really good thing. So like to Rachel's point of like, LegalZoom or other kind of document assembly type programs, and clients asking us, why can't I do it on that? Well, I mean, the answer is you can. And like there's nothing in like the US Constitution that says you can't do that. So you can do that. It might not be the smartest thing for somebody with a more complex situation, but to the extent that those kinds of programs open up access to legal documents that are important, like that's a good thing, because really the legal industry prices out a lot of the population because it's just very expensive. Same thing with wealth advisory and financial advisory firms. To a degree, they price out a large portion of the population. So to the extent that technology is allowing access into the industry where it wasn't really available previously, I think that's a good thing. I think probably what we would all agree on, but of course you're very free to disagree with me once I say this, but probably what we would all agree on is that like that access is good. The platforms are not always conducive to wise access. And so something like a Robinhood, for example, where it's great you have access and you have free trading, quote unquote, but that doesn't give you any sort of guidance on what is a wise way to do that. If you have, say, $200 that you actually want to invest and start investing with, just going into Robinhood and picking a stock might not actually be the smartest thing to do without some kind of education behind it.
Yeah, that's a fair point. And I'd say the way that I've always described it is, just like not everybody wants to go and rewire their dishwasher, right? So similarly, not every individual investor wants to go and completely do it themselves. Some people choose. I always say that you either don't have the time, energy, willingness, or expertise to do it yourself. That's when you either look to a professional to do it, or then there's a hybrid, which is what I call the robo-advice world, which is kind of in between. You have full service on one end of the spectrum, you have do-it-yourself, like a Robinhood or a discount brokerage on one end, and then you have a segment in the middle, which is where the robo-advisory, where they want a little bit more than what sort of a complete do-it-yourself would be, but you're not really getting an a la carte, not getting a customized solution. It's kind of still fairly cookie cutter. So but all of these have a place. I think that's the thing that people always forget is, you'll have one side of the equation that's always bashing the other and vice versa. They all have a place. And I think they're all necessary. And I think ultimately, as the end user's perspective, that's actually great because now you have choice, you have options. And as you mentioned, Brent, it's totally true. A lot of industries were historically priced out for your average person. And so this has actually really opened that up for more and more people to participate. But like with everything, buyer beware, right? So you have to have a degree of savviness. You have to do your due diligence. You have to do your research. Because unfortunately, in some of these scenarios, there's no one's there to tell you no in a lot of circumstances. So you can get yourself into a lot of trouble if you're not careful. And I think that's really where, sometimes people need to learn and kind of fall flat on your face a little bit in order to make sure you don't make that mistake again. We just want to make sure that you don't make a really costly mistake where you're doing things that you can actually cause sort of major or massive amounts of harm to yourself. And not to say that that can happen in a, guided or advice type situation. That can always happen there too. But the idea is that there's more checks and balances, and that the probability of that happening, given that there's layers and layers of people watching what we all do, that should be less. So I think there's an argument to be made that that's why the spectrum of advice exists. And depending on your comfort level or your needs, or as Rachel mentioned, I agree completely, your complication. So depending on how complex your situation is, then perhaps one scenario is better, or if you have a really complicated situation, then maybe having a full service environment might be the best solution. Or the variable that I think everyone doesn't talk enough about is how much do you care, right? And I think that's a big one. Is there's some people who really, this is not where they want to spend their time. Like you have to have a real passion for it. And if you don't have the energy, the willingness, or the expertise or care to do it yourself, then that's when you bring other people in to help you with it.
Absolutely. So one of my friends gave me a really great quote, what they're saying for the do-it-yourself investors: the worst mistake you can make for yourself is being right, because then you've got that confidence to keep going and to, make a bigger bet basically the next time. And I think that's funny. And I think it's true in one sense, but it's also true in the sense where, like you were saying, if you're doing it yourself, you really do have that passion and you're investing the time and reading all the financials, everything like that, then that's that's good. That's a great thing. And maybe being right will give you the confidence to take maybe the next step further. But maybe, you should also take a step back and not put your entire portfolio into Dogecoin, let's just say. So maybe a couple of weeks ago, that could have been a good idea. Who knows? But I think that's definitely something to consider. And I know Brent and I have talked about this before. My husband is a big investor, loves to do it on his own. He's just very passionate. It's his new side thing. And it's great, but it's also good to just like we've checked in before with a financial advisor, with a wealth advisor, just, hey, how are we doing? And just getting a little bit of advice. And then that's it. And he's still going on and doing his own thing. So I completely agree with you. It's a little bit of everything for anyone. And that's a really good thing that at least we have now.
Yeah, you want to figure out, where do I fall, right? And what is the best scenario? Maybe a check-in is all that I need. It's like, hey, am I totally off base here? And I think that's what people don't value, I think, enough in the world of advice. And one of the things that's really interesting phenomenon to see is, you have this sort of, like you mentioned, people, I think, sizing their positioning in very interesting ways in the last year. And as a professional advisor, portfolio manager, I think that's actually one of the hardest parts about our job. It's, you can come up with all the reasons to justify, okay, well, I think X is a great idea. Okay, well, now that I've come to that conclusion, how much do I put on? How big is my bet? Right. And that's really the hardest part about this whole job, and why, people always criticize portfolio managers. Oh, they don't necessarily beat their respective indices and whatnot. And the main thing behind that, and a big variable that people don't always look at, is we have to look at risk more than we have to look at necessarily trying to inch out the highest possible return. Or what we look at is return for every unit of risk that you're taking. Right. And so we always want to look at that and make sure that we are, frankly, staying in business, right? Like, the idea is you don't want to blow up, right? And that's, I think, one of the biggest problems that people end up having is they don't size their position quite, adequately for what their risk tolerance should be. And then all of a sudden you're now in a situation where now you've overextended in one area, and now you may not necessarily get to play again. And I think this is where people are always critical of the professionals out there that, oh, your rates of return are muted by comparison to what I could do if I threw it all in something wild. That'll always be the case. But the idea behind what we do is more consistency. Is you want to stay in the game, get a more consistent rate of return over a period of time. That way, again, you can just keep participating and allow the compounding effect to happen. And everything is always, again, subject to your own individual suitability, your comfort level, your risk tolerance. And if it's not something that how you feel about any of those things, then that's when you may want to contact your financial institution, contact a financial advisor, and make sure that you are doing something that you are comfortable with. And I find that's actually the biggest thing about my job, that is the most interesting part, is you have people who may have the appetite for risk to be fairly high, but then perhaps they may not have the tolerance to have that risk to be high enough, or vice versa, where when there's a mismatch, that's, I think, what causes problems for people overall. It's just, how do I feel about risk overall? And I think that that's not an area that your retail investor typically spends a lot of time thinking about, but we as institutions and financial professionals, we think about that a lot. And I'd love to see over time that kind of being a more broader conversation that your average person talks more about, because everyone always talks about when they did, made that big bet and it worked out awesomely. But do you talk about the ones that you totally struck out on? Probably not. So I think this is a conversation I'd love to see more people talking about.
Yeah, absolutely. And I think there's a big difference between, say, taking all the money that you think you're going to use investing and putting it into one position that you think is a sure thing, and the thing that you're describing. Like the process that you're describing is not the same as just sticking all of your money in positions that you think are bets. And it's one is, to your point, one is extremely risky. The trying to make bets is extremely risky, and the other is a lot less risky. Because as you're saying, like, you're actually sensitive to the fact that there are risks, the fact that there are risks in particular positions and exposures, and that there are ways to then mitigate against being unreversibly harmed by one position not doing as well as you had expected, because nobody has a crystal ball. And so you really can't, without some sort of insider information, you can't possibly always pick the right investment. If you're trying to pick them on a single investment by single investment basis, like, it's just not possible. And you're right. Like, you don't hear people talking about the big losses. It's only the unicorns of like the huge wins. The Doge coins, the GameStops, those sorts of things where it's like these huge wins where the multiples are just ridiculous. Like nobody talks about the multiples that have a big negative in front of them, or they've got like parentheses around them. But that's the reality when you're trying to pick single investments and hope that they pop off, that you're going to lose.
Well, so this is the difference between gambling and ultimately investing, right? So, or
Yeah.
speculating and investing. And I think that's why I always encourage everybody to, if you're not sure, seek out guidance and make sure that you have a really good idea as to not only what are you doing, but more importantly, why. Are you investing for the long term? Are you trading for a period of time to get out, a certain technical rate of return? Whatever it may be, whatever your strategy, just make sure that it's sound, it's defendable, and that you can look yourself in the mirror, for example, and say, "Look, I did that, and I knew." And like I said, position weighting or sizing your position is literally one of the hardest jobs that we have as professionals. So it's fairly straightforward to come up to, like, I think X, Y, or Z company is a great solution, but then it's harder to say how much do you put on it. And the one thing, at least, that we implement in my practice is that no position should be big enough to make or break you, right? So, if you got it and you're totally right and you hit your achievement and your target, then you shouldn't be able to go retire on a boat somewhere on it. And then at the same time, if it totally, okay, that totally didn't work, then you shouldn't be sort of on in line trying to get food. So I think this is where you need to really be careful about how you do things and just be a degree mindful of, unlike sports where you can go and, even if you swing for that home run and you strike out, you'll get to play again. In life and in finance, if you strike out big, you might not get to play again. And this is why I always caution everybody is you don't necessarily need to have the highest rate of return in the world. You need to have a consistent rate of return and allow time to do your heavy lifting for you. The longer that you have in your horizon, the less risk, funny enough, you need to take, but it's counterintuitive because that's not what people think, because it's not always sexy, right? And I think that's where we're always fighting, and where sort of this whole Robinhood phenomenon that we've seen in the last little while has been kind of front and center. Is the pandemic put everybody at home, and they closed off a lot of regular activities that we all used to do. So at least in my case, more so than I think a lot of other people, but because of that, you had a lot of people that kind of picked up on investing as a new hobby. I think that's great. And it's great that people are stepping in to learn more about an industry and in an area that's been frankly pretty mystified for a long time. But you have to do so with caution, is that there's real consequences if you don't do it correctly. It's real money. It's real scenarios. And unfortunately, we did see a lot of that happen with GameStop and other things over the past few months. And it's been really interesting to watch this unfold in 2 decades of doing this professionally. I haven't seen this kind of thing happen before. So it's unique. I'm going to let the lawmakers and regulators comment on the validity of these things, but it is really interesting, and there is no free lunch. So you have to just always be aware of what you're doing.
Yeah, so good. And the other part of that, of course, is, for your clients, you're helping them create an objectively tailored plan for them. And then as you pointed out, you're the check and balance on them, right? Or the plan is the check and balance on them. So they know if they're straying too far away from that plan or straying too far away from your advice, that they're entering into waters that could be risky, or waters that at least you and they have probably not adequately analyzed, to figure out, like, is this actually going to get them to the objective they want?
Of course. I think one of the things that we are always proponents of is what we refer to as a plan-based benchmark. Is what does it really matter, honestly speaking, what the S&P does in a year, or in Canada, the TSX, or whatever? Like, really, what does that matter to your life? More importantly, we should look at where do you need to be and how are we doing, right? So that's why I'm such a big proponent for actually running a financial plan and making sure you're at point A, you want to be at point B, whatever that may be. What do you need to do to get there? And is it realistic? And then ultimately working backwards. And that's as simple as financial planning really is you may have multiple objectives. We take into account potential, risks, rates of return, and all these other variables that kind of go into it, but ultimately create a real benchmark that's more relevant for you in your life. And I think that's the most important piece that at least a lot of our clientele take away from it is, how am I doing relative to where I need to be? And then that's where we know what levers we need to pull. And are we under? Are we over? And in some years, you may be, getting an excess return in preparation for the not so great years. And ideally, over time, it's never a straight line. It's usually a sine wave, right? So usually ups and downs. And our jobs as professionals are to kind of minimize the peaks and valleys and to make it as consistent as possible and allow time to do that heavy lifting for you, however much time you have. The longer that you have, the less risk you technically need to take. But that's not necessarily going to match up with what your desire for risk or your appetite would be. So you always want to test for tolerance, understand a person's and an individual's comfort level or appetite for risk, and be able to create that full risk picture or profile. That way we know, are we doing something that's making sense and that's suitable for you? I think that's ultimately what professionals try to do. And I don't think, like going back to our earlier point, enough retail investors take any of that into account. Because there, in a lot of scenarios, we've seen people like, I'm putting all my money on red. Well, okay, great. But that could go great or that could go totally poorly. And you may get a confirmation bias because you got it right. And then you think you could do it again and again and again. And it'll all work until it doesn't. Right. And I think that's, the biggest thing that are fears that we have as professionals is we just want to make sure that investors, get the proper guidance, get the proper coaching, and are in an environment that they can sort of sleep at night, ultimately, with the decisions that they've made.
Yep. And helping them to frame it like you're describing, frame the reality of what they're doing in the proper context, like time, right? Helping people think about it on a long time horizon with a long chronology that frankly most people don't think about things in that way. It's the exact same with kind of our high net worth clients. When they're, say, making large gifts to family, which is a popular way to do wealth planning in the U.S. or kind of wealth preservation type planning in the U.S., they very often, even those clients, they view it as it's a gift of X dollars on X date. And I always feel like I'm struggling to explain to them that it's not a gift of X dollars on X date because you have to project it out over 20, 30, 40, 50 years. It's a gift of the value of that money in 20, 30, 40, 50 years, which is exponentially higher than what it is today. That's the thing that they're actually doing. But most people just don't view the world on those sorts of long time horizons. But it's so critical to what we do and to what you do and to helping people achieve their goals.
Absolutely. And I think, sort of a final point on that. I don't want to belabor the point, but
yeah,
I think it comes down to we as humans, I think, really intuitively understand linear growth, but we don't necessarily understand compound growth because it's not easy to fathom. Like if I take a couple steps, I know how far away I am. But if I'm taking compounding steps, I could be really far away. They don't really understand that. It's like trying to, if I were to give it as an example, if I gave you two chalkboard erasers, we're dating ourselves here a little bit because I don't think they use those anymore. But if I took two chalkboard erasers, I told you kind of uniformly clap your hands in front of you, you could do that all day with two chalkboard erasers. But if I replace that with magnets, all of a sudden you do this, then it's kind of slapped towards the end. And I think that's because the movement gets stronger as they get closer together. And that's really kind of an analogy for compounding growth and why it's such a powerful tool that I think people just don't necessarily have the patience to let that work. That can do your heavy lifting for you. You don't have to bet the farm on every little thing that you do. And I think it's an impatience thing. It might be a youth thing. I don't know. But I've seen this happen to people of all age categories. So I think it's just a human phenomenon that we want it like yesterday. We're not willing to wait. But that's why it's patience is a virtue, and all good things come to those who wait. But it's easier said than done. It's harder for people to do. But that's the one thing, at least I can take away and tell people, is that psychologically speaking, we're not intuitively wired to understand compound growth and the power of tax-deferred compound growth, going back to the reasons to use Roths and traditionals and RSPs. The reasons why we use these things is tax-deferred compounding growth. It can be one of the most powerful tools that, it's just kind of there and you're not really looking at it because it's not jumping out at you. It's not super sexy. It's not, GameStop going up thousands of percent in a couple of weeks. But slow and steady, and it does typically end up winning the race over time. So tried and tested methods sometimes are always there for a reason.
sometimes it turns out they're there because they actually work. So
Absolutely. Well,
surprise.
no kidding. Well, I appreciate you guys giving me another chance to come onto the show. It's always great to talk about these concepts and, just to be a little bit jealous of your sunny weather down there. But
It's our pleasure. We thank you very much for taking the time. Per usual, we'll add your contact information in the show notes so people know exactly where to find you. Of course, they can also Google you. You'll show up pretty quickly. So thank you very much, Shiraz. We appreciate it as always.
my pleasure. Thanks again, Brent. Thanks, Rachel.